Right, good day, everybody. It's the 6th of April 2020. It's the Trend Signal Trading Podcast. This is Adrian Boothby here, Head of Trading at Trend Signal, and I'm joined with my colleague, Chief Market Analyst at Trend Signal, Jerry Miller. Hello, Jerry.
Morning all.
So today we're going to be talking about how the markets have, I guess, relative stability over the last week or so. Certainly quite strong on the equity markets today. Volatility dropping off sort of major highs on the VIX, and this is largely down to the infection curve, arguably flattening a little bit. So we're going to be talking about that as we go through today's podcast. So Jerry, why don't you kick us off? What do we know? What happened last week?
Golly. Well, the markets did sort of calm down somewhat. Stock markets, for example, the FTSE, DAX, all slipped marginally, but nothing like the previous 3 weeks. The Dow was down. Sorry, the DAX was down about 1%, FTSE just under 1.7% down, so very, very modest compared to previous weeks. US markets and Far East markets slightly different. The Dow was down 580, which is about 2.7%, S&P down 53, that's 2%, whilst the Nikkei suffering from a stronger yen temporarily, that was down about 1,500 points. But definitely had a quieter week, though. Volatility is starting to subside, as you said. And the VIX, cracky, Adrian, do you remember when we were talking about it, a couple of weeks ago when it peaked around 89 or 88? It just felt like it was going to keep on going higher and higher. Anyway, the VIX is at 45 now, so very much down from those very elevated sessions from 3 weeks ago.
It's not quite the same thing, but you can see that 44.1 at the moment, VIX, and you can let's get rid of that. I need that. You can see how the size of the candlestick is significantly smaller last week, compared to some of the heady candlesticks of the previous few weeks, which were just a bit ridiculous, really, weren't they?
Yeah, I mean, just pretty mad. But so it's not just equities, of course, Adrian. We were also talking about the dollar quite a lot recently. It doesn't seem to have been experienced the same sort of calming effects that the risk correction has gone through with equities. Certainly it seems to be resulting in cooler heads for the stock market, but the dollars continue to benefit from this haven buying as investors prefer to park their cash in US dollars.
Can we just talk about safe havens for a second? I was talking to a client just last week, and he was asking if we could do just a few moments about safe havens. So what is a safe haven, Jerry? Can you explain?
Okay, first of all, probably the best explanation is to tell you what is not a safe haven, or what is riskier. The riskier investments, believe it or not, are shares. Those are the ones that go up and down a lot more. When companies' fortunes improve, the stock prices can go up significantly. And likewise, as we've seen over the last 3 weeks, stock markets have absolutely collapsed. And investors then put their money into something that they know is going to be safe, i.e. it's not going to lose value, or tends not to lose much value, and that will be sovereign bonds. So those are bonds issued by governments. They always know they're going to be repaid by a government, because governments just tax their tax-paying public for money, if that was the case. And other safe havens like gold, and also the dollar. So these are sort of more reliable instruments that you can put your money into when there's a significant sort of amount of doubt about what's happening with economies, and that risk off, as it's called, it can be quite dramatic, as we've seen. But that risk correction, I think, has calmed down now. So now you're seeing a little bit of not so much safe haven buying. So people are not rushing to buy bonds, not rushing to buy gold and the dollar, although the dollar does seem to be benefiting from this haven buying, as I've just mentioned. So,
well, quite especially since we really look at the US contagion is sort of it's probably the epicenter of the virus now, isn't it? Perhaps, arguably.
Yeah, I'd say it's heading towards 250,000 infections, so it's just way outstripping the likes of Spain, which has become the top country in Europe now, just surpassing Italy. But it's just interesting. I don't think that's anything to do necessarily with directly with any infection rates and stuff, but I just think as a global sort of investment, the dollar is the safest currency you can put your money into. A lot of things are priced in dollars, so it is the sort of weapon of choice for investors who are rushing to liquidate their investments, i.e. shares and other investments, and they put their money in dollars, and that's it really.
Yeah, okay, that should be very helpful. I mean, obviously we've looked at instruments like gold, which really has taken a bit of a hit in early mid-March. Ordinarily, you'd expect it to be a bit higher than perhaps it is at the moment, although it's certainly recovered. But of course, those people haven't listened to previous podcasts. In a way, this has been used. Institutions have been selling their gold assets in order to fund or go into cash so that they can buy, I guess, equities at a discount, aren't they?
Yeah, that's right. I mean, yeah, gold had a weird week, really. It did actually close unchanged on the week, but when you look at the chart, you can see that it did still trade in quite an elevated range. I think that from the bottom, from the start of the previous week to the low, I think it had about a $70 range, which, gosh, I mean, I've been in this business since 1980, and to see a range of $70 in gold in a week is considerable. But I know we've been having $70 ranges in a day. Just extraordinary. And I think gold's sort of safe haven status has been a little bit obscured by liquidity issues, the dollar strengthening, the dollar weakening, and also in Switzerland, the temporary closure of these refining facilities because of the virus threat. So that disrupted a lot of the physical gold supply as well. So some of the spread betting companies, as I said last week, the quotes were $10 wide, Adrian. Frightening, as it were, if you dare trade it for that on that sort of a spread.
Yeah, absolutely. Okay, so what about that's great, thank you. I think our client will be very, very happy with that. What else has been happening then? What about oil? That's been had a hell of a week, didn't it?
You've hit the nail on the head. I mean, oil, first of all, I'll just give you the numbers. Oil eventually closing up on Brent, so that's UK oil, that's the sort of benchmark outside the US, that closed up a whopping $10 on a price from sort of whatever it was, 23, 24 bucks. That's a 40% increase, Adrian. US oil, so that's what we refer to in other descriptions as WTI, or West Texas Intermediary. That's the domestic oil in the US. Still $7 higher as well. That was what, 32%. So significant moves. And this all started last week when Trump tweeted that there was a potential deal being agreed between OPEC and Russia to cut production. If you remember, about 3 weeks ago, that OPEC meeting in Vienna, where Russia sort of balked at further production cuts because they felt it was just feeding the US shale oil business, and Saudi Arabia just sort of threw a complete tantrum and walked away from it. And the next day, or that weekend, if you recall, they not only did they not cut production, they ramped production up. And not only did they ramp production up, they also discounted their price by up to sort of 30% to take market share from Russia and other producers. So at a time when oil consumption was collapsing because of COVID-19 and their lockdown, Saudi Arabia engaged in this sort of very destructive behavior, which I call it's a price war really with Russia. Anyway, that's the bad news. The good news is that Saudi and Russian oil executives have been meeting, state people have been meeting to try and agree some sort of a deal. And that was sort of released last Friday, but weekend news also came out that Saudi Arabia and Russian officials were exchanging accusations about who was responsible for the breakdown in talks in Vienna 3 weeks ago. It's not particularly helpful, really. I think they were going to have a meeting today, Adrian, but I think the two sides are still sorting out their negotiating positions and wanting to pre-frame it really before this emergency OPEC meeting on Wednesday this week.
It's funny because, you know, something you said earlier about that, you know, that was the bad news, but of course, you know, to the untrained eye, you'd think that low oil price is good for us because it means, you know, low prices at the pumps. Although we're in this sort of weird situation where we can't even benefit from that because we're all in isolation. We're not even buying any petrol, so we're not even getting the benefit of the cheap price. But anyway, of course, what it really means is that oil companies are taking a massive hit. So the good news that they do sort it out and that petrol does become more expensive is because it means that the share prices of BP and Shell and so on will hopefully go back up again, which is good for our pensions, basically.
Yeah, that's right. I mean, they're massive dividend payers, and a lot of income funds are absolutely lost without the likes of BP and Shell and some of the banks as well that pay good dividends. And I think it's a big problem, as you say. I don't know when the last time you filled up, Adrian. I mean, I've done probably 15 miles in the last week.
Yeah, it's bizarre actually. Just my meter's just not going well. I've been out 2 or 3 times in the last 2 weeks. I mean, that's
Yeah.
it. Just go to the
I
shops.
mean, really, what we should do is buy an oil tanker or petrol tanker,
Put it in our garden
and fill it up and make sure it's got about 10,000 litres in it. That's how to make some money out of the price down here. But as you say, realistically, by the time all this is sorted out, when we do need to start using petrol again, it'll be back up again. That's just the way it works. But it's extraordinary. They're talking about cuts in production of up to, well, there were reports of 15 million barrels per day. If you compare that to what they were trying to sort out in Vienna 3 weeks ago, that was about 1.5 million barrels per day. I think that's probably a little bit over the top. Realistically, I think OPEC could agree maybe 10 million barrels per day cut, but they've got to get everyone on side. And Saudi Arabia has said it would support a deal as long as all global producers are involved. And I'm thinking, well, surely that should include the US shale oil producers. But Trump hasn't made any commitment to involve or even persuade US shale producers to join in the cuts. So, yeah, it's a bit of an odd one.
And of course, that's possibly one of the big catalysts was the US becoming the biggest oil producer, isn't it, with shale oil? So that's one of the things that started this thing in the first place.
Yeah, that's right. Because Russia just said, what's the point in cutting production? Because all we're doing is giving more and more market share to the US shale oil industry. And that's sort of true to a certain extent. But remember, a lot of that US shale oil it's all domestic oil and it doesn't get exported. But of course, it just means the US is importing less Saudi and Russian oil. I think they import Russian oil, I'm not sure. But anyway, the weird thing about it is that with prices down in the low $20, many shale oil producers are really existing on a bit of a wing and a prayer, Adrian, because they're all pretty much running out of cash. Their production costs.
Just to be clear, that's because the costs are more than $20, basically.
Yeah, they're sort of they need oil, world oil prices around $50 really, and so you'd think with the oil price down here, a lot of US production is going to wane anyway. So just by the laws of supply and demand, they will not be able to make much money out of supplying oil at this price. In fact, they'll be losing it. And the good thing about shale oil business is a lot of it can just be turned off. It's not like they've got these rigs in the depths of the North Sea or the Gulf of Mexico. It just needs electricity to power them. So they can be turned off and on relatively easily.
I guess is the shale industry, is that being surviving on subsidy in the States then?
No, what it's they're basically running out of cash though. A lot of the investors that have been supporting these companies will be looking at it and just thinking, what is the point of continuing production just to lose money? You know, the better thing to do is in all likelihood is to sort of reduce production, because why sell something for $20 when perhaps in a couple of months' time you'd be selling it for $50?
Yeah, exactly. Good. Okay. So, well, we hit the end of the quarter, didn't we, last week, Jerry? So, It's certainly been one of the more interesting quarters for the definitely in my memory, that's for sure.
Mm.
But
Yes.
it was an interesting start, wasn't it? Literally straight out of the gate, we had the US-Iran spat, and then obviously this the coronavirus, and it's easy to forget that it wasn't that long ago that the US equity market was hitting new all-time highs. Unbelievable.
Yeah, it's been an extraordinary sort of development, really. A lot of people are saying that it almost feels like we're in another world, a surreal world that suddenly is foist upon us. And we started out the new year full of lots of promise, and you've already mentioned that Iran US spat that everyone thought was a start of World War III and everything else, but as soon as it started, it was over. And then the US markets just carried on hitting record highs. And we've had these discussions previously in podcasts where we've talked about the fact that the US was in denial whilst COVID-19 was raging away in China, and surely it was going to get out. And it was only when the reality dawned on the rest of the world that infections were starting to build in Italy, so outside Europe, and the rest is history. So Europe has pretty much become the global epicenter for the coronavirus. And although I do think, as you just mentioned, the US looks like it's going to be taking over, but participants struggled to price in the risk, really due to the coronavirus. Swathes of the global economy have shut down, as we know, to protect our health services and to protect the elderly. But the markets then suffered these falls, just a precipitous sort of under sort of scores it in a way, but it's even worse than that. Investors just didn't know what to do. Pricing in the risk was just impossible to do in a way. So investors
just don't know which companies are going to go to the wall, do you? That's the problem. So what do? You sort of sit there, buy and hold on, or liquidate, and that's what people were doing.
A mass sort of liquidation of positions, really, and that's what a lot of investors did in those sort of those in mid March, and moving into cash, mostly the US dollar. But markets tend to sort of swing wildly, and whilst perhaps they were a bit overvalued on the 19th of February, maybe that pendulum that was swinging down as the markets crumpled, I think that was probably a little bit too far on the downside. So it looks like we probably bottomed temporarily, as we were mentioning last week, but markets do have a tendency to have a second look, don't they? So
yeah, they do.
Really, it just depends, how the governments are going to play the exit strategy and how this lockdown progresses.
Yeah, it's interesting because there's all these cases are sort of escalating in the US. Actually, really, we've seen the US stock market rise. So it's almost like it was ahead. It's like 2 weeks ahead of actually really where the news is. Perhaps, I don't know. We'll see. So how does this fall rank with other falls? I mean, we've had the great the recession 2008, the 1930s. Jerry, where do we sit alongside those?
Well, we thought, Adrian, if you remember back in 08, remember it all started with Bear Stearns in March 08, culminated with Lehman Brothers in September 08, and then the market hit the low in March 2009. And it really did look like someone was turning the lights out. But this, in comparison, is a lot worse. So markets have really fallen a lot faster and a lot further than how that happened in 2008. And actually, it's not since the Great Depression, and I'm talking about the 1930s, that have economies sort of been so badly affected.
Yeah, I mean, I look at the FTSE 100 chart, the monthly chart here. You see the size of the candlestick on the monthlies in the last 2 months. Just unbelievable. I mean, you look on the far left side of the chart, you've got the 2009 lows.
Yeah.
Okay, that's pretty big in September 08, October 08, but actually still quite a bit smaller than than certainly month. I mean, that's an unbelievable candlestick.
That is just shocking, Adrian. When you look at the size of those.
Look at that for the Dow by comparison. I mean, it's just mesmerizingly different.
Yeah, it is worryingly so. But yeah, it was. It's interesting. So we referred to it before, the way that the market suddenly realized that this was going to be a global pandemic, despite the fact that the World Health Organization hadn't quite classified it as such at the time. But the markets just absolutely cratered. So the US entered a bear market. And remember, Adrian, a bear market is where a market falls 20% from its peak. And the US did it in 16 days. 16 days to fall 20%. I mean, just extraordinary. But
Yeah.
the previous record was actually in 1929, and that's according to the FT, when it took 44 days. So we're hitting some pretty dire records, aren't we?
Absolutely. Yeah. Yes. I mean, it's interesting. Of course, it wasn't. We didn't have any bear market last decade at all, did we? And it took us only a couple of months to hit one this decade, didn't we? Very, very strange.
I do think the magnitude of the fall, though, Adrian, is probably a function of how far the elastic band had been stretched in terms of the bull market. But you know, when you look at it where we were a couple of years ago, it hasn't fallen so far. if you know what I mean.
No, quite. Okay, and what about growth? I mean, we had some conversations last week about a few forecasts coming out there for the year in the UK. What are people suggesting about GDP for the year? Because obviously we're going to take a bit of a hit in Q2, aren't we, with economies in sort of relative shutdown, really. Hi, you there? So, I mean, one thing that there might have a few sound issues there for Jerry, perhaps. Maybe it's my end, but I'll keep talking.
Sorry, Adrian, I think I might have lost you here.
Well, I'm still talking, Jerry. Hopefully you can hear me okay. I can hear you absolutely fine. Just bear with me a second. Well, look, I'll carry on anyway. I mean, economists are now really rushing out forecasts for the likely hit on economies. In the UK, economists believe that the UK will sustain a collapse in GDP of around 15% in Q2. I mean, that's obvious to see because a lot of people have been furloughed and not working right now. So, or they've just been lost their jobs entirely. So 15% in Q2, which is worse than the great financial crisis, the worst we've ever seen, really. In the US, Goldman Sachs has predicted a 34% annualized contraction in GDP in Q2. Of course, that's just for one quarter, so the likely hit in Q2 is sort of 12 to 14% in GDP as well. So similar sort of numbers. I think it's Bloomberg economists there have suggested that maybe looking at an overall fall for the year, probably around 4% GDP in the UK. Unemployment wise, Goldman Sachs is predicting that unemployment will skyrocket to around 15% in the US by the mid-year, which is an increase of 11%. I think it went down to a low of around 3.4% unemployment, and literally just a couple of months later we could up at 15%. And of course we saw some fascinating claimant count data last week, where the previous, you see there, I can't remember what we were expecting. I think 2 or 3 million new unemployment claims coming in, and it came in at 6.6 million unemployment claims. So quite an unbelievable number for the week here now. From the 9th of April, we're expecting around 5 million new unemployment claims to be coming through. But as ever, it's not so much about what's on this economic calendar. It's more at the moment about the contagion. It's about the spread, although hopefully the slowing down of the spread of the coronavirus. There we've got in Australia, we've got interest rates decision there on Tuesday morning, but wildly expected to have no change, to keep it unchanged at 0.25%. Otherwise, CPI inflationary data looking for a fall on Friday from previously 0.1%, so a small growth in prices, to a fall of 0.3% there. As for last week, we had the non-farm payroll number, and I have to say we looked at the forecast, and it was coming in at falling like 100,000 jobs or something as the the forecast there. I remember saying to Jerry that, if only you could trade payroll, actually trade the number itself, because I'd have had the most almighty spread bet on that to short it, because it was never going to be as high as 100,000 or as good as only 100,000 losing their jobs. 700, 1,000, obviously. Of course, we've seen as well, but it came in at 6 million. These are the sorts of numbers that are going to start to come through now, unfortunately. Very, very unpleasant data that we're seeing there. Unemployment rate gone from 3.8% to 4.4%. Really, this is a little bit in arrears, really. I think what we're going to see is the big impact is going to take place in the May number, which will really factor in everyone's payroll for the month of April. So what you're going to see there is that people who had their job in in March, they still had some of it or still had it, but it's going to be more the impact of people losing their jobs at the end of March and into this month here. So this is where we're really going to see it for next month's unemployment rate data coming in there, and of course non-farm payroll employment change too. So there we are. Consumer confidence coming in slightly ahead of expectations, which is interesting. But generally speaking, lots of these indicators are more sort of lagging indicators. They're looking at something that's already happened in the past, whereas it's really the here and now that the markets are reacting to. So it's really the news wires, it's the data of cases, it's announcements of going on. It's news like this, European stocks and US data showing slowing growth in the coronavirus spread. That's the fundamental reason. We understand why the equity markets are rising today. Those are the key drivers of the equity markets at the moment. So look, it's all a bit weird on the sound at the end there, I'm afraid. I'm going to call it an end to the session now. So thanks very much for being online with us and listening to the podcast. We continue to do these every Monday, and there's a lot we can talk about, a lot we can go through in the markets. And if you've got any ideas of topics or anything like that, please just jot us an email to info@trend-signal.com, and then you can tune in and we can field one of your two of your questions. We're very, very happy to do that. Ultimately, we do this to help inform our clients, our students, and traders around the world better about what's going on in the market. So we'd love to hear from you. And again, we'd love to hear from you about your feedback about how you find these podcasts, any ideas, any other stuff that you'd like us to talk about in these sessions will be well received. Now, one thing that we have realized or noticed in these turbulent markets is some fantastic trading opportunities as well. So it's sort of a bit weird to sort of be gleeful. I don't really want to come off gleeful here because it's a horrible situation, but at the same time, there are some fantastic trading opportunities to be taken from the volatility in these markets. So as an example, our end of day trading strategies picked up around 4,000 pips of profit for March alone. So really, really healthy month for end of day traders and short-term traders on the intraday trading strategies, taking some great benefit out of the short-term volatility as well. And what I'd like to do is invite you to attend one of our trading webinars. We host 3 live trading webinars a week. This is a great time to be getting into the markets and learning a new trading strategy that can help you take them on and hopefully be a lot more successful with your trading decisions. So if you'd like to come along and have a look at that, all you need to do is go to trend-signal.com and then you'll find somewhere on the website there the ability to book in a place at one of our upcoming events. What you can also do, let me just bring the slide up, give me a second. Here, you can also go to the short link, which you can see on screen now as well if you're listening to it. If you're listening to us, I'll read it out as well. So that's bit.ly, so bit.ly/learnts. So bit.ly, bit.ly/learnts, TS for Trend Signal. Okay, otherwise, stay safe, everybody. Have a great week on the markets. Stay in lockdown and keep your friends and family safe. And we'll tune in again on Monday next week and catch you all again soon. Bye-bye for now.